All right, guys, December 15th, end of the day, we're going over our S&P biggest gainer and biggest loser. So on Market Watch here, the actual biggest gainer was a REIT, so I'm going to ignore that one for now. It was apartment investment, something like that, 16.4%. Not going to go over it. They take a lot more investigation and explanation of their balance sheet and profit and loss statement. I'd rather just focus on companies that provide a service or a product. So the biggest gainer today was Wynn Resorts and Hotels out of Vegas. And then the biggest loser was Tyson Foods. Not a big loser because today in the market overall was up a lot. So your biggest loser is probably not going to be a big deal, which it wasn't, 2%, not a big deal. So for Wynn Resorts and Casinos, I was looking at why it was a big gainer today, and there wasn't much news on Market Watch. So I went to Y charts to look at it, and it seems like, if I'm reading this right, the big reason they went up was they're issuing a new unsecured note, which is basically debt, like a credit card, unsecured, and it didn't affect their rating by Moody. There was a $625 million note. They're probably doing that to raise cash to see themselves through this COVID outbreak. I was supposed to stay at Wynn just 2 weeks ago. I canceled my trip, and they gave me a full refund. So their cash flow is going to be an issue. Their PE is garbage right now because they make no money. They lost $1.9 billion in the last year on $3 billion in revenue. Revenue is down a ton. Their dividend's been suspended. So it's really skip all of this stuff right now, and let's go to their financials. If you look at we're going to look at the quarterly financials. I want you to see how different their numbers are now from quarters in the past. So in the last quarter, they did $370 million in revenue. The same quarter last year, they did 1.6. So they're down, what is that? 70% in revenue, but it's up a lot from the June quarter of $85.7 million. Their net income is negative $760 versus negative $3.5 million. So even last year, in the September ending quarter, they still lost money when the previous year before that made 156. So this might have been already in the down, starting to go down anyhow last year. Number of shares outstanding, slightly higher, not much higher, but slightly higher, down from a few years ago, but slightly higher from the same quarter last year. Not enough to really matter. Their balance sheet, this will be something important to look at as they go forward. They have $3.9 billion essentially in cash, and they have $1.7 billion in current liabilities. So a good number there, but look at their total debt. Their total debt over the last year has jumped up quite a bit from $11.6 billion to $14.5. Makes sense. Raise debt to pay the bills, to be able to stay afloat while they wait for the doors to open back up and COVID to go away so they can start generating more revenue again. So let's look at their free cash flow over the last few quarters. In the most recent quarter, they lost about $250 million in free cash. They had a negative $173 in loss from operations, which is better than $430, which was worse than the quarter before that. So their cash from operations last quarter was a loss of $173, and the previous September quarter of 19 was a $270 million gain, and their quarter from 18 was a $444 million gain. So that's not going in the right direction. They spent a lot of their money on capital expenditures. A lot of these casinos have to spend a lot of money making sure they're upgrading, doing great things. That's why I don't really like them very much, because they tend to be high debt and high capital expenditure businesses overall. I'm not a huge fan of buying these resorts just in general. But again, Wynn's probably one of the better brands in Vegas. The question is, are their debt levels sustainable? So overall for Wynn, it's a risky play, but I'm a big fan of Carnival Cruise Line at these prices. I have not done the exact numbers on Wynn and what I paid for them, but for $12 billion, I think there's probably better buys out there. 4 times revenue, even during a big downturn like this. It just seems a little scary. Now, granted, you might look at their stock price and go, damn, they were at $450 before, now they're at $115. Yeah, but it doesn't mean they weren't expensive back then. So even in January, they were at $150. So I look at it going, man, $150 versus $114, so down about 25% currently, even though we don't know when they're going to open back up. They have a lot more debt than they did before, and they're still generating a lot of losses. Doesn't seem like a good value proposition to me, but again, I could be wrong. I just don't feel like that's the right play right now. So anyhow, that's my opinion on Wynn. Let's go to the biggest gainer the biggest loser of the day. Oh, actually, Eli Lilly just came in to tie Wynn for the day. But Tyson Foods, TSN. Let's look up Tyson Foods. Tyson Foods, $25 billion company. PE ratio of 11.6, so it has a check mark there, below 20. Low profit margin, which was expected for a company like this. So they're probably in the high volume, get a lot of volume in, make small amounts of money. They paid a 2.5% dividend on $25 billion. So that's 250 times 2 is 500, another 0.5%, so $600 million roughly in dividend payments per year. So let's go look at their financials. Let's go look at their annual, actually, because it's probably a more stable company. 36 billion 5 years ago, 43 billion in the most recent annual. So definitely revenue growth there. Profit growth, 1.77 billion to 2.1, so check mark there. Number of shares outstanding, 385 to 363, so another check mark there. So they are growing, not at a big clip. It's expected for a company that already does 25 billion selling food, so pretty good so far. Let's look at their balance sheet. Cash on hand, about 7.9 billion. One thing I want to mention that I don't mention very often, inventories is a big number here. I want to see how fast they're turning that inventory over because it is food, it is perishable. We want to make sure they're turning that inventory over very quickly. We don't want them to be stuck with inventory, but 7.9 billion essentially in cash and cash equivalents and 4.2 in current liabilities. So they have enough money on hand. Basically, their current liabilities is their inventory, essentially. So they have enough cash on hand to pay their current liabilities. Cash flow, my big one. Let's go to their cash flow statement here. Now remember, cash flow is operating cash less capital expenditures. We want to see that be growing over the last 5 years. So 5 years ago, it was about 2 billion. Today, it's about 2.7. So awesome, it's growing, check mark there. Now what we want to do is we want to add up all of the cash flow for the last 5 years, add up all the capital expenditures and see what the average is and then multiply it like a PE. Over time, earnings and cash flow should be pretty similar. So their average free cash flow over the last 5 years is 1.85 billion. Now, typically I say I want to pay about 20 times that if the company has some decent growth potential. This company's not growing a ton. So I think paying 15 times free cash flow is a reasonable number, and we're at 27.7 billion. If you remember, the company was about 25 billion. So it's selling for a reasonable number. They spend about $600 million a year free cash flow, so they can easily cover that. So I'm liking the way it looks. Let's look at their last 12 months. Their last 12 months, they generated, because it's the most recent quarter. So actually, it seems like a pretty reasonably priced company from the standpoint of free cash flow. They have a pretty decent balance sheet. I don't know what their debt looks like overall. Let's see how their overall long-term debt looks. Are they increasing it by a lot? Are they not? Let's see year over annualized. Long-term debt. I mean, they're up a lot since the last 5 years, from 10 to 14.9, but there was a big jump here. My guess is they probably made some sort of acquisition. We can check their their cash flow statement to see when they made acquisition here. Divestitures, there it is, $3 billion acquisition right there. So they took on the debt to buy that. So another $2.3 billion acquisition here. So they're doing acquisitions to grow. So I think that 12 to 15 times free cash flow, you're probably going to be fine buying at today's price. But if you can, as it goes lower, you want to sit there and spend some time buying shares at lower prices. You know, if you could buy it back in the March pricing, 45, low 40s, I think you're going to do pretty well. They pay a pretty healthy dividend, 2.5%. As that stock price goes lower, the dividend yield will go higher, and they can easily afford that dividend of $600 million a year. So guys, thanks again. December 15th. Subscribe. You'll be able to see my end of the day recaps and we release videos twice a day, 1 p.m., 7 p.m. Our 7 p.m. recap. 7 p.m. video will be a recap for the end of the day, the biggest gainer, biggest loser of the stock market, of the S&P that day. Thanks again. Hit the like button, subscribe.